Hello and welcome to the video with a summary of the main rules about accounting for employee benefits as prescribed by IAS 19. I am Sylvia of cpdbox.com, the place to be if you want to understand and apply IFRS easily. CPD Box can help you pass your exams, get your CPDs if needed. Plus, there's a ton of another great stuff for both students and professionals, so you're welcome to check everything out at cpdbox.com. The standard IAS 19 was issued in 1983 for the very first time, and then it was enhanced and amended multiple times, and the major revision came in 2011. The main objective of IAS 19 is to prescribe the accounting and disclosure for various kinds of employee benefits. Employee benefits are usually provided for employee's service or work that he or she does for the employer, and in exchange, the employer provides salary, paid leave, bonuses, and other forms of benefits to the employee. And therefore, the standard IAS 19 requires the application of so-called accrual principle to recognize a liability for that benefit when the employee provided service to the employer, and to recognize expense when employer consumes the benefit from employee's work. IAS 19 classifies employee benefits into four main categories. The first one is short-term employee benefits that are payable within 12 months after the end of the reporting period, and these are provided to the current employees. For example, salary, paid annual leave, paid sick leave if paid within 12 months. The second category represents post-employment benefits that are paid after the completion of employment, and they are other than termination benefits. So in other words, they are provided for employees' service rather than due to termination of employment. So what's in? For example, pensions, retirement bonuses, post-employment medical care, and so on. The third category is other long-term employee benefits, and these are simply other than short-term benefits, post-employment benefits, and termination benefits provided to the current employees. For example, jubilee or anniversary bonuses, deferred compensations, long service leave, and so on. The fourth category represents termination benefits, and these are quite different from the other three categories because they are provided in exchange for termination of employment rather than for employees' service. For example, severance payments, bonuses for accepting the termination of employment voluntarily, and so on. So as you can see, each category has its own characteristics, and therefore IAS 19 deals with each category separately. And let's take a look to the first category, short-term employee benefits, that are employee benefits other than termination benefits that are due to be settled within 12 months after the end of the period in which the employees render the related service or do the related work. Short-term employee benefits include items as salaries, wages, related social security contributions, paid annual leave and paid sick leave, profit sharing and bonuses, and various non-monetary bonuses for current employees such as paid medical care, car, housing, free haircuts provided by Google, what have you. The accounting treatment is quite simple in this case. Employer recognizes these benefits as an expense or maybe as an asset when permitted by the other standard, for example, as cost of conversion of inventories according to IAS 2. And on the other hand, a liability or accrued expense is recognized in the amount of an expense less amount already paid. The second category of employee benefits defined in IAS 19 is post-employment benefits. And these are employee benefits other than termination benefits that are payable after the completion of employment. Examples of post-employment benefits are retirement benefits such as pensions, various post-employment insurance or medical care plans, etc. There are two basic types of post-employment employee benefits: defined contribution plans and defined benefit plans. It is very important to identify whether you deal with one or the other one because accounting treatment is completely different. And there are two main differences between the two that help us to make clear distinction and classification. First, it's where the entity's or employer's obligation starts and ends. And the second one, who carries actuarial and investment risk of the plan. In a defined contribution plans, the employer has usually obligation just to contribute certain amount to the fund and nothing else. And then the employee will get benefits from this fund based on the amount of these contributions, investment return on funds assets, etc. And therefore, we can say that actuarial risk and investment risk fall on employee. On the other hand, in a defined benefit plans, employer has usually obligation to provide agreed benefits to the current or former employees. For example, when there is a collective agreement signed with trade unions stating that employees will receive certain benefits at retirement, an employer must pay those benefits regardless any contributions to the fund. And therefore, actuarial and investment risks fall on the entity. If the assets in the fund are insufficient to meet expected benefit, then the employer must find other resources to pay it, but he must pay it. Now, let's explain relatively simple and straightforward accounting for defined contribution plans. So, as the employer's obligation is limited to making contributions, no actuarial assumptions are necessary here. It is that simple. Entity recognizes contribution paid as an expense in the period when the employee renders the service. And where other standard allows, contribution can be included in the cost of another asset, for example, into the cost of property, plant, and equipment in line with IAS 16. On the other hand, entity credits liability or cash, depending on whether the contribution has already been paid out or not. Of course, when the payment of contributions falls beyond 12 months after the end of the reporting period, it's necessary to bring them to the present value using the discount rate that we will talk about later. So let's start to explain the defined benefit plans, and I must say that this is really one of the most complex areas overall in IFRS. And let me illustrate why. So here there is a certain employment timeline of the employee who was hired, let's say, in 20X1, and we assume that he stays with the company until his retirement in 20X41. Now, let's say that the company provides retirement benefit to all of its employees based on employee's final salary, years in service, etc., and that is payable when the employee retires. So it will be paid out in 20X41. And how much will the employer pay? Well, we don't know, because who knows what the salary levels will be at that time, and if the employee will still be alive and employed in that company. So we need to estimate the amount of that benefit years before it is paid out, and this is a challenging job. Therefore, we must use certain actuarial assumptions like mortality rates, inflation, future salary rates, demographic data, and number of other things. And this is quite complicated, and usually actuaries should do that for you. Also, because it's defined benefit plan, we cannot account for expense and liability at the time of retirement. Instead, we must spread the expense over a full employment period in this case. So simply speaking, we must accrue some expense every year of employee's service. When we look to actual current dates, it's let's say 20X10, our employee is in service for 10 years. So he has been serving for the company for 10 years, and the company should have recognized certain portion of expenses and liability for the benefit that will be payable 30 years later when the employee retires. Well, of course, not full benefit, because employee will earn significant portion of that benefit in future years of service. The company just recognizes portion of the benefit already earned by the employee. So for the periods from the start of employment until the current reporting date. And now we are coming to the present value of defined benefit obligation, which is the present value of expected future payments required to settle the obligation resulting from employee service in the current and prior periods, just as shown in this bracket. This defined benefit obligation builds gradually, year by year, just as employee works for the employer. And believe me, it is not easy to estimate the amount, because this is something that the employer will pay out in the far future, but must estimate now. So here we come to actual assumptions like future salaries, inflation, mortality rate, fluctuation rate, etc. Current service cost. This is the increase in the present value of a defined benefit obligation resulting from employees' service in the current period. In other words, it is the expense for the benefit in exchange for employees' work in the current period. Now, employers can face pretty high liabilities at the end of employees' service, and therefore some of them have a fund or plan to which they might make certain contributions in order to cover liabilities from benefits in the future. So this way they protect themselves from big cash flow variances and they literally make savings for future payouts. So when we want to show the net defined benefit obligation from this employee benefit in our financial statements, we must deduct the fair value of these plan assets from present value of obligations. So this is the outline, what a defined benefit plan is. And yes, it seems very complex because determination of how much you will be liable to pay in the future is subject to many changes, and in many cases, actuaries are involved. Also, you need to apply so-called projected unit credit method. And this method sees each period of service as giving rise to additional unit of benefit. Well, what does that mean? Looking to the employment timeline, let's take shorter employment of just 7 years now, from 20x1 to 20x7. Each year of service represents separate unit of benefit, and an entity recognizes each unit of benefit in individual years of employee's service. And moreover, each unit shall be measured separately to build up final obligation. And when measuring those units, we must not forget that the whole post-employment benefit obligation must be discounted to the present value. In this short summary, I don't want to go to further details on application of this method and on accounting for defined benefit plans. So please check cpdbox.com. There are many other videos and articles illustrating many accounting concepts, including this one. And also, we have amazing course teaching you reporting in line with IFRS in a very simple and easy way. So maybe that would be a great resource for you too. Another category of employee benefits is other long-term employee benefits, and these are all employee benefits other than short-term benefits, post-employment benefits, and termination benefits. And examples of other long-term benefits are long-term paid absences such as long service or sabbatical leave, jubilee or other long service benefits such as a lump sum remuneration at the 50th birthday of an employee, long-term disability benefits, profit sharing, bonuses, and of course, any kind of deferred compensations paid 12 or more months after the compensation is earned. Now, accounting for other long-term benefits is similar to accounting for defined benefit plans, but easier because these benefits are not subject to so much uncertainty as defined benefit plans. Well, but you need to apply projected unit credit method too, and of course, some actuarial assumptions are also involved to some extent. The last category of employee benefits is termination benefits, and this category is different from previous ones because here, the event that gives rise to benefit is termination of employment and not employee service itself. IAS 19 sets a number of conditions and rules around when to account for termination benefits and which benefits qualify for termination benefits, and also accounting for these benefits depends on their character. So if the termination benefits are enhancement to post-employment benefits, then the entity applies accounting for post-employment benefits. So just as an example, let's say that you plan to close the nuclear plant in 5 years and your employees will lose their job. And let's say that you need some employees to stay until the end of those 5 years to finish plant's operations gradually and smoothly. So you promise to pay to these employees bonus of, let's say, 100,000 currency units in return for their service until the end. So this type of a benefit because you are paying them to stay until termination, not for actually leaving. If termination benefits are expected to be settled within 12 months after the end of the reporting period, then the entity applies requirements for short-term benefits. This is clear. And if the termination benefits are not expected to be settled wholly within 12 months after the end of the reporting period, then the entity applies requirements for other long-term benefits. So that was a short summary of IAS 19. And if you'd like to learn more, please visit our website cpdbox.com and subscribe to our free newsletter and explore tons of other materials. Thanks for watching.